folks. It's Dave Burrows. I'm Chief Investment Officer and CEO here at Barometer Capital Management. I want to thank everybody for joining today. Lots to talk about over the last week, quite a week, lots of price movement, lots of different groups moving around. And let's take it from the top and kind of go through things as we do, sort of from a macro view, and then drill down into some subgroups. Just to start off with, obviously, we continue to believe we're in a structural bull market. And I think that when you go through a 23 or 24 month period where markets don't make new highs, it feels like forever. But the correction that we've been going through, which you see on the far right of the screen here, is, really unlike what you see in a secular bear market, 2000 or 2003, 2007 through 2009. 1973, 74, and so on. So when we look at markets as it is, we're about 8% off the highs from December of 2021. We've been through 2022 and most of the way through 2023, and you can see we are yet to make a new high. But certainly the last week and this month so far, has started out pretty well. Our view is that bear markets come in time and in price. This one's been a combination, at the worst point down about 25%. And, we now sit a couple of months away from 2 years, but it does not look anything like what we've seen in secular bear markets. But of course, that's the thing that people are afraid of. We look most like the mid bull market correction, 1990-91. Did wind up being a recession here in Canada, very, very tough for real estate going through that period. It was a significant rate hike cycle. But ultimately you came out, and what came next was, 4 great years in the stock market. And then another correction, another 3 great years. So this has been going on now, this bull market, since 2013, 128 months. Market to the high point of about 176%. Sorry, to the current point. And that doesn't compare to what we saw in the 80s and 90s. So maybe this will be different. But, secular bull markets tend to last 15 or 18 years. We're about 10 years in. My guess is we're probably halfway through. Looking at the S&P 500, going back over the last 2 years, we topped out in December of 2021, sold off through until October of 2022, when we believe we put in the cyclical low. Markets made a series of higher highs and higher lows since then. We pulled right back in actually 5 waves, which is unusual. Made a low just about a week ago, and boy, has the market gone through a bounce since then. So when I look at it, it was about 10.5%. On average, we get sort of a 10% correction once a year, and we have had more than 15% correction through the bear market, so unlikely we see another one soon. But we've talked about this. In October of 2022, 2 things were happening. You were getting a sharp run up in yields, and that was putting pressure on all risk assets. 10-year yield made a high in and around 4%, and at that point got quite overbought. When it started to pull back, it took pressure off of stocks. The stocks started to rally. And of course, we've had a series of higher highs and higher lows since then. But when we rallied in yields again and went through the 5% level, again, that put pressure on stocks. Yields were moving up quite quickly. And when we put that together, the overbought condition with what was happening in the US dollar, it was the same cocktail. October of 2022, we were making highs in the US dollar versus the basket of world currencies. Again, tends to put pressure on risk assets. We had this March higher from mid-July through early part of October, when we talked about being overbought in the US dollar. And with both of those backing off, it really served to take some pressure off of risk assets. And then certainly the Fed conference last week sounded as though the Fed may be closer to done. So We've talked about seasonality, and the pullback that took place from the 26th of July through the beginning of November, was more significant than it tends to be. We look at the seasonality 1950 to 2022. However, the turn came pretty much on cue. Now, we talked about this a little while ago when the year was positive, but we got 3 consecutive months of decline in August, September, and October. It tends to be that November, December are strong. Final 2 months of the year being positive 80% of the time, and the 6 occurrences that had taken place since 1952. So the average return for the month of November was about 3.7%. We're actually up about 4% over the last 6 trading days. Now, when we look at the 4 days around the last 2 days of October, first 2 days of November, when the trailing week was down less than 1% in the last 50 years, the 4 days tended to be positive, and I guess this was no different. So what do we get? Monday, Tuesday, Wednesday, Thursday, Friday, Monday, Tuesday. It's quite a run. When we look at the way that it happened, it's significant. First of all, we had breakaway gaps higher. That's a market that's a little bit panicked. We know that positioning has been very, very light coming into the most recent month, and we know that sentiment has been exceedingly negative. Now, this is difficult when this happens because 2 things take place. First, you have some investors that decide they probably should put some money to work because they're underinvested. 2, portfolio managers who are behind the curve realize that their careers are at risk. They better put some money to work. And 3, there were a lot of people who have been short this market, and specifically certain themes, that probably realized they'd better cover. So the difficulty is discerning between what is real buying and what is short covering. The problem with short covering is once it's done, if the security or group is still broken, the buying dries up and you see it back and fill. The real buying should see continued pressure. So some things we take away. First of all, we talk a lot about breadth. We like to know what's happening underneath the surface. So this is a measure that looks as a measure of advances versus decliners over a 10-day period. And we're looking for a significant number of advancers over decliners. So this is called a Zweig breadth thrust. There's another measure that's quite similar called a Whaley breadth thrust. Both of them look at the strength of the launch that takes place. And when this triggers, it tends to be, as you can see on the chart since 1945, important turning points for markets. So if we go back and take a look at the performance coming off Zweig breadth thrusts since 1962, we can see that in the case of 1962, 63 days out, market was slightly negative. In 2015, 63 days out, slightly negative. But the numbers are pretty overwhelmingly positive. Between 90 and 100% positive, and 100% positive 6 months and a year out. The largest drawdowns, 20-day drawdowns, were not very much, and the 20-day run-ups were significant. So the risk reward, when this takes place, it tells you something's taking place. Money is being forced into the market. Now, we know that there were tremendously large short positions. The long-short ratio in asset managers was exceedingly low. You have to go back to just after 2010, 2011 to have seen people be so negative. Now, outside of the S&P, we know we've seen some strength in Japan. This is relative strength versus the S&P since December of 2021, marching smartly higher. We know that India has performed quite well also after a long bear market. And interestingly, I'm watching Brazil because it's a large market with lots of interesting companies. It's been in a bear market since 2008, and we're just starting to tip up out of this pennant formation, which could be quite positive. Now, we talked over the last year that global stocks have a real opportunity to perform better than they have relative to the S&P. And this is potentially a broadening taking place. We also note that in general, Latin American shares have been performing quite well also. Let's talk about bonds. Now, we've talked about the fact that we think that we saw generational low in rates in 2020, similar to what happened in the late 1940s. We've had a very, very sharp move higher that clearly reversed the downtrend in long-term interest rates. This is 10-year yields from 1981 to 2020. We pushed higher. We got overbought in October of 2022. When they backed off, the market rallied. We got overbought again recently. And 2 weeks ago, maybe it was 3, we said, look, it's now overbought. We think that the risk that bonds could have a bounce is higher. We're covering our short positions in the bond market. We're not necessarily going to push a bunch of money in. We talked last week about taking some money and going out to 3 years instead of holding just straight cash. That proved to be timely. We know again that the hedge funds were exceedingly short the bond market, and that adds fuel to a fire. Now, when bonds rally, that's good, but it may well be that other assets rally more. And of course, in the last week, bonds bounced, but stocks bounced more. When we look at the aggregate bond index bounced between the beginning of last week or end of the week before and today about 2.6%. Over the same period, the S&P 500 rallied about 4.5%. So stocks relative to bonds continue to have a very clear trend in place. I'd rather own stocks than bonds. We're in a bull market, long-term bull market in stocks. And versus the major alternative, bonds, stocks look more attractive. When we look at equity dividend growers, which we've talked about over the last couple of years, equity dividends growers relative to bonds for income investors also more attractive on a relative basis, outperforming. Talk quickly about commodities. We reversed a commodity bear market in 2020. We rallied into the Fed's beginning of the tightening cycle. Commodities consolidated through the tightening cycle, and about 4 months ago broke out to the upside. They continue to consolidate over the last 2 months. Tougher day today for energy. We'll talk a little bit about that. But in general, we think then that commodities relative to bonds, more attractive, and commodities relative to stocks look more attractive. But this just means that this is a group that should be considered if we think we are in a more inflationary environment, and if we think that we are into a rising rate period that will move higher in fits and starts. This is a group that tends to do well because it's a limited supply and often has pricing power. Okay, so we don't have to be everywhere. Our job in these webcasts and with our clients is to try to identify assets that are in the process of being revalued versus the alternatives. We're trying to find areas of market leadership where we can see that money's getting put to work that ultimately can lift price. We don't want to wait till it's obvious where everybody's decided they need to be there, because often you can be the last one there or one of the late ones, and that can be costly. We want to see money start to get put to work and start building positions, and then ideally be there for a period of years while those assets get revalued. Our job is always to be watching for change, and in the absence of leadership, have a willingness to have some cash on the sidelines. So since the end of July, we did have some cash on the sidelines. It got as high as about 30%. We started taking some of that cash and moving it out to 3-year bonds. We were looking at dividend growth stocks and looking for groups that were outperforming the rest of the market where breadth was remaining firm. And that list got very, very narrow. So this is not about being like the market. It's being tactical and picking our spots and trying to make sure that the portfolios are in line with what's actually happening, not what we would like to see happen. Our basic belief is 70% of return comes from getting to the right neighborhood, get to the right asset class. Within those asset classes, identify sectors and themes that are benefiting from the current condition. And then find securities to use to express our view. Sometimes that's ETFs. Very often, and most often, it's rifle shot individual positions. We're trying to find securities that are good, getting better, where we can see fundamentally things are improving and technically they're sound. Where we can find securities that are good, getting better, and they line up in groups that we see net new money getting put to work in, that's where our portfolio should live. Now, the truth is the market is constantly changing, and we have to be ready to change with it. And one of the most important skills that we have to have is discipline around an exit. It's easy to make investments. The hardest thing to do is to know when to sell. And we use stop losses. Of course, we're looking for fundamental shifts in the companies that we're invested in to try and recognize where something that's been improving over a period of time starts to run out of gas. But at the end of the day, we need to use price as a discipline so that as positions work out as we hope or expect, we're going to ratchet stop losses up and behind. Then ultimately, if they start to fail, you don't let a little mistake turn into a big one. From a top-down perspective, we're looking for parts of the market that are seeing expanding breadth. When we get to late in a decline, very often a few securities quietly start turning higher. Could be in a specific sector or a broad market. But if breadth is expanding, it's a healthy market. It means money's flowing into more and more securities. There's no bear markets ever take place while breadth is expanding. When breadth is expanding, we are very comfortable being invested and making new commitments. When breadth starts to contract like it did in the third week of July, it means that we stop putting on new positions. It may be that there are some that just do better than all the rest. But if breadth starts to narrow in a specific sector or a theme or an asset class, it means we're swimming against the tide, putting on new positions. The one we put on could be the next one to get hurt. So when breadth is contracting or fewer and fewer securities performing well, we sit on our hands until we start to see expansion in breadth. So let's take a look at the world. As of 2 weeks ago, our long-term indicators, which are measuring the percent of stocks in uptrends, had been declining, meaning fewer and fewer stocks performing well. Now, certainly, there were some performing well. At the worst point, about 28% of stocks were in uptrends, meaning that 72% of stocks were broken down. The percent of stocks trading above the 50-day moving averages had been declining, meaning fewer and fewer. Percent of stocks with positive weekly price momentum had become very narrow. Percent of stocks making new highs versus new lows was exceedingly low. And the percent of stocks trading above their 150-day or longer-term moving average, again, has well below 30. What a difference a week makes. We talked last week about some positive divergences that we were seeing taking place in some of our short-term indicators. And we've seen some significant change this week, both in long-term globally in the US and in our short-term indicators. So let's talk about that a little bit. A week ago, we highlighted that while the market was making a lower low than it was in early October, more companies were trading above the 50-day moving average than they were in early October. So when that number's declining, we mark it out in zeros. That means that breadth is falling. We rallied a little bit in early October, and then it sold off again, but higher percentage of stocks held above the 50-day moving average. Now, here we are a week later. We've moved from 16% of stocks above the 50-day to 46%. So 30% of companies went from below their 50-day moving average to above their 50-day moving average over the course of 6 days. Now, that's one measure. When we look at the percentage of stocks trading with positive weekly price momentum or upward trajectory, we noted that actually this measure hit its low in August, rallied through September, the 9th month, fell through October to a higher low, rallied again in October, and then fell to a higher low as of the beginning of last week, and was close to reversing up. Again, what a difference a week makes. We've moved from 26% of stocks having positive weekly momentum to 66%. When these reverse up from below 30, it tends to be significant. Now let's look at the last one, bullish percent for the NYSE, the percent of stocks trading with positive trend. We measure this using point and figure price charts. We hit a low of 28% as of 2 weeks ago. And as of today, we're at 36%. Does it mean everything has reversed into a sustainable trend? No. But it means the balance of evidence is that the percent of stocks in uptrends has started to expand. So when our short-term indicators turn up and our long-term indicators turn up, it's time to put money to work. Now, we don't have to rush because the buying is going to be a combination of some short covering, which can fool you, and some real buying. What we want to see is what happens when inevitably the market pulls back for 2 or 3 days. What is it that gives gains back? What is it that holds on to the gains? The things that hold on to the gains, or the things that were most constructive to begin with, are most likely to be real buying. So from a sector perspective, as of last week, the average sector had 24% of stocks in uptrends. If you put everything on a distribution curve, if everything's stacked up on the left side here, it means that a small percentage of stocks are in uptrends. The ones with capital letters coming in were the strongest. It meant that the percent of stocks in uptrends was expanding already, and energy was right there. Insurance had pretty good breadth, energy service, but then a whole bunch of economically sensitive groups that had failed to really sell off. The weakest groups were high multiple stocks and defensive sectors. Now, again, what a difference a week makes. We've moved about 7% higher on average by group. Look at the number of groups with capital letters, meaning the percent of stocks in uptrends is expanding. Look at the groups that turned higher. Banks, Wall Street, that's capital markets and asset managers. Steel, aerospace, well, that's defense, that makes sense. Home builders, restaurants, retail, forest products, machinery, savings and loans, that's the regional banks. At the other end of the spectrum, what has failed to turn higher so far? Well, high multiple, some of the defensive groups like real estate, telecom, drugs. So this is something that we use to inform us as to where we should be positioned. Now, as you can imagine, if groups were to the far right to begin with and moved farther to the right this week, then that's something that we're interested in. Now, our job is to make sure the portfolios stay in tune. And trust me, it's been a hard 24 months, not for you, not for me, for all of us. Let's look at what has been leading. From a relative strength perspective, since December of 2020, energy has been a leading group. You can see by the rising relative strength line versus the S&P 500. Now, today wasn't a very good day. When we look at the, I jumped ahead a slide. When we look at the XEG, which is the Canadian Energy Index, we could look at the XOP, which is the ETF of US producers, all the same. They were down about 3% today. When we look at the relative strength line, there's been a fairly clear upward bias going on, and we came out of a bear market that goes back to 2014. After consolidating, going through the Fed's tightening cycle, we broke out, but certainly a little money came out of energy because it was one of the only groups that was working, and we've seen a little backing off. We look at uranium, same thing, higher highs and higher lows, rising relative strength. As of last week, we were trading very close to a 52-week high for the group. Cameco and NextGen Energy were both trading at 52-week highs, and they continue to be trading better than 94% of companies in S&P. This is not broken. Tech, after months of May through September, trading sideways from a relative basis versus the S&P, a very, very good week last week. The XLK is made up of the largest of the large cap technology stocks, and in general, they've reported pretty good numbers. The trend in relative strength has been higher since January of 2023, about 10 months now, and that started after a decline of 30% off the highs. Insurance continues to be close to 52-week highs, nothing changing here. Fairfax this week reported their earnings. They beat, and the stock acted very, very well. Now, capital markets asset managers and capital markets banks in general have had a stronger relative return over the last number of months and had a very good week last week. We'll see whether this follows through. This is a shift. The Canadian banks had a little bounce, but you can see relative strength has been falling and really has not done very much to change. So this is the type of thing I want to be a little bit careful of. When something is technically broken, and the Canadian banks equally weighted ETF is down 31% over the last 90 weeks, 2 years. It bounced last week, a little bit less than the market, failed to get back above the level that it broke down from, failed to really significantly change from a relative strength perspective. My guess is that's been a lot of short covering, and they probably have some difficulty to face as Canadians go through a very significant mortgage reset. In the materials, steel, surprisingly, if we think that we're in a recessionary camp, why is it that the relative strength of the steel sector has been outperforming steadily since June of 2020? The SLX is trading better than 86% of companies in the S&P. Had a very sharp rally last week. We're trading above all the moving averages. This is in an uptrend. Now, may well be that this reflects the fact that there's infrastructure spending in the US. It may well be that it reflects reshoring of industry. It may well be that it reflects the fact that we've moved from a US-centric world to a multipolar world and supply lines are being redrawn. But this is something that we want to take note of, because you don't want to say the market's wrong, we're right, we have a negative view of the economy, so we better not be there. It may well be that people who think that way are wrong. SLX, to me, looks quite attractive, and if we get through sort of $70, it looks like it could go a lot higher. Staying within the materials group, there have been a number of groups that have gone through this long consolidation while the Fed was tightening, and interesting, the forest products group broke out of this wedge last week. Now, again, we'll see if there's follow through. Stella Jones here in Canada, that makes railway ties and telephone poles, had a really, really good earnings report. And some of the wood products companies are doing particularly well. Just something to note, because again, more economically sensitive group. Industrials. Well, on a relative basis, the equally weighted industrials versus the equally weighted S&P has been rising pretty steadily since May. Had a decent week last week. The defense stocks, which we talked about last week, continue to relatively outperform. So that's a group we want to continue to focus on. Communications, and specifically the two big companies in this sector, Meta and Alphabet, performing very, very well, making new relative strength highs. If we take those companies out and look at telecom's making relative strength new lows. So this is an odd group, but in particular, we've taken a rifle shot approach to owning Meta and Google. Home builders. Look at the relative strength here from March of 22 through current, trading better than 88% of companies in the S&P. This is the ITB made up of the home builders, D.R. Horton, Lennar, NBR, Pulte Group. Had a very sharply higher week last week. This, I would say, is not short covering. You got a positive trend in place. You've got rising relative strength. This is something to take note of. So a couple other things that stand out. US dollar backed off a little, and gold broke this little downtrend. This is a very long chart back to 2005. Traded above the uptrend. We'll see whether this can get going. It's also interesting that Bitcoin, and we're not big Bitcoin bulls, but Bitcoin made a 52-week high. And if we look at the very long-term chart, the bear markets in Bitcoin have been about 80%. That's a big bear market. And in each case, when they made a new high, had a very significant run. The bear market in Bitcoin, to the point where the lows were in October of 2022, November, was about 77%. And now we're making 52-week highs, just something to keep an eye on. Things that really haven't changed very much. The parts of the market that you would expect you'd want to own if you wanted to be defensive. Look at the relative strength trend in utilities. A bounce last week, but this is still technically broken, trading below all the long-term moving averages. We'll watch to see if something more can come of it, but I would still be pretty cautious. You had a little bit of a pullback yesterday and today, while the market was up. That's some buying has dried up. Same things happened with consumer staples. A group that's relatively been weak, had a bounce last week, but my guess is sitting below the moving averages, it's got more work to do. REITs, a terrible relative strength trend. And frankly, with mortgage prices moving higher and the cost of money being more expensive, a little bit of respite last week in yields doesn't probably change the situation. Real estate is a difficult asset to own if we've made a secular shift in the long-term direction of interest rates. And finally, high multiple tech, whether it's biotech or high multiple tech. Again, both had very significant bounces last week, but really did nothing to reverse trend, actually just rallying back up underneath the point where they technically broke down. So we still got to pick our spots. There's certain parts of the market that are well owned and well loved, like large cap tech, and we're there. There's other groups that are maybe not as obvious, but are performing well, and are things that we're not going to avoid, like the home builders, like the defense stocks, like steel, like materials, like industrials. When we look at our weightings, not huge change over the week because we don't have to race to do anything. The money that we moved into 3-year bonds had a nice bounce. They provide some ballast. Energy continues to be in a relative strength uptrend. We're going to watch that closely to make sure that we don't see any material breakdowns. Technology a little bit higher than we were a month ago. When we work through the groups, you can see not a lot of change. At the bottom end of the spectrum, we haven't added real estate. We haven't added utilities. We continue to have a relatively small weight in consumer discretionary. And we got a relatively small weight in consumer services because it's 2 companies, Google and Meta. Consumer staples, we moved up slightly. We have a couple of great positions there. We talked about bell ring brands. We talked about Dollarama. For the last few weeks, they continue to perform well. But we have taken our cash down. I guess the bottom line is the backdrop for all of these positions has become better in the last week. Seasonally, it makes sense. From a positioning standpoint, it makes sense that money's had to go to work. When we look at breadth has shown very clear improvement. And then we look at sort of the secondary factors that we care about, volatility. I'm looking at it a little bit differently this week. This is the most recent spike in volatility. You can see it's been a series of lower highs since the worst point in this last 3 years, the COVID sell-off. This has been a really unusual period and a lot of disruption. You had the COVID sell-off. You've had the tightest Fed tightening cycle in history. And through all of that, we've had a lot of volatility. But the volatility has slowly been subsiding as the world's supply chains have come back into balance. And as we've rebalanced some of the inventories. And we're now down in an area where markets tend to do well. When volatility has been between about 20 and 10, markets have their best returns. After the tech wreck, stocks rallied from 2003 through 2007, 4 great years. And through that period, we had very muted volatility. Then, of course, we had 2008-9. Coming out of the financial crisis, when things started to settle, when the secular bull market began at the end of 2012, we then had 3 years of low volatility. And the markets were exceedingly productive, 2013, 14, and 15. Then China slowed down. We had a bounce in volatility in 15 and the beginning of 16. But then 2016 through 18 were very, very productive. We had a Fed temper tantrum at the end of 2018. Then volatility came back down in 2018 through 2020 for just fine until COVID hit. So I find it interesting as we tested some of the lows over the last 3 months, volatility failed to make a new high. And now volatility as of late this afternoon was at 14.8, measure of volatility VIX. So how long will it stay here? But once it comes back down, it tends to stay down for a longer period of time. My guess is between now and the end of the year, there's going to be a little bit of a chase as portfolio managers need to put some positions on, because it may well be that the market's looking beyond a Fed tightening cycle. Economic data has slowed down in various places where it needed to slow down. Employment numbers came in last week, a little bit lower than what was expected. It's probably a good thing. The PMI data reflects the fact that manufacturing has been working off some excess inventory. These are the things that we've been going through over the last 2 years, worrying about inflation. And once you go through corrections, you start to look forward 12 or 18 months. So volatility is telling us that things are getting better. From an earnings perspective, this quarter has been pretty good. The average company beating the earnings estimate by about 7.5%, about the best earnings surprises we've seen over the last several quarters. Credit risk is muted. The excess yield that bond investors are demanding to buy either corporate credit or high yield credit actually come down, and certainly not extended like it does tend to be at periods of stress. And the economic surprise index has in general been moving higher. So we'll continue to watch for risks. But it's most important for us to understand what the market's telling us. Breadth is most clearly improving. That means that we have a supportive backdrop for the positioning that we have in the market. We'll watch sector by sector as breadth improves and more groups participate, and we'll look for opportunities to make timely purchases. But seasonally, we're now into a better period of time. And looking forward, we'll continue to use our stops and we'll watch for change. But the net of it is, I think that we're in a pretty good position. So if there's any questions, certainly happy to answer them. We'll do this every week for as long as you want to come back. But we do this as a discipline. It forces us to re-examine our weightings and re-examine our portfolios consistently and be transparent about what it is that we're doing. So I'm looking to see if there are any questions. The one question I have here is the failure of Citizens Bank a significant concern? Well, when we look at Citizens Bank, it's not the largest bank around. One of the major concerns from a regional bank perspective has been the losses on their bond portfolios. With yields backing off, those losses are somewhat less. We spent a lot of time looking at credit stress. And while the delinquencies on auto loans has been going up, it's well within the 5-year range. So it's not outside of the last 5 years. And the last 5 years have been pretty decent. So in general, I don't think that the Citizens Bank issue is a big one. Having said that, our financials exposure largely is in property and casualty insurance. And then we own JP Morgan, which really is not a concern. So an anonymous question from a viewer asking about today's action in the energy sector. And it was weak. There's no question about it. Oil broke $80, traded down to $77.50. The XOP, which is the Energy Producers Index, is pulling back towards support. The services companies pulling back towards support at the 150-day moving average. Both of those are trending higher. So unless we start breaking those moving averages, I think this looks like a pretty typical pullback. It's happened in 3 waves down, and we'll continue to talk about that as we go forward. You know, we've got a lot of M&A taking place. Crescent Point making their acquisition last night in Canada. You know, and having to raise some capital. These companies are generating a lot of cash. Now, there are lots of hedge funds trying to make bets that if the economy slows down, we would use less energy. And there's cross currents, of course, coming from Eastern Europe and now the Middle East. But at this point, we have not seen any significant breakdowns on the point and figure charts. So we remain in our positions. I think that's it. With that, I thank everybody for joining us. If you got additional questions, give us a call. Certainly happy to answer your questions. Send us an email if you'd like to have a conversation. You know, that's what we do. We talk people through issues and give our input, and hopefully it's useful. So thanks very much for joining us, and we'll take another crack at this again next Tuesday. Everyone have a great week.